Welcome to Talk Tickers. You're here for the key takeaways from today's earnings calls, fast.
We cut through the noise so you don't have to.
Exactly. And today, we are diving into FUBO's first quarter 2025 earnings call.
Right. And the big headline, they actually beat their own subscriber forecasts globally.
And met revenue guidance, too. So on the surface, sounds pretty good. Let's unpack that a bit.
Definitely. So let's drill into North America first. Their streaming side had 1.47 million paid subscribers.
Okay, 1.47 million. How does that compare?
Well, it's actually down 2.7% compared to last year. But, and this is key, it was above their guidance.
Okay, so they expected worse, basically. What about revenue in North America?
That actually went up $47.9 million, which is a 3.5% increase year over year.
Interesting. Fewer subs, more revenue, points towards higher ARPU maybe, average revenue per user.
Seems to be the story, yeah. And it ties into their broader focus on the bottom line.
How so?
Well, globally, their profitability metrics improved by over $100 million. That's on a trailing 12-month basis.
$100 million improvement. That's significant.
It is. And net income from continuing operations came in at $188 million. That's 0.55 cents per diluted share.
Which sounds amazing compared to a net loss last year. But there's a catch, right?
There is. A pretty big one. That number includes a $220 million gain from settling some litigation.
Right. You have to strip that out to see the core performance. So what does that look like?
If you look at adjusted EPS, the loss improved quite a bit, down to just 0.02 cents from a loss of 32 cents last year. So a big step up.
Okay, that's a clearer operational picture. What about adjusted EBITDA?
Also much better, negative $1.4 million. That's a $37 million improvement compared to last year.
So operationally, definitely tightening the belt, moving towards profitability, even excluding that settlement boost.
Exactly. They're pushing hard on cost control and, efficient growth.
Makes sense. And cash? How did the cash flow look?
Net cash provided by operating activities was $161 million. But again,
the settlement money flowing in.
Right. Free cash flow is maybe a better measure of the underlying business cash generation.
Yeah, how's that?
Still negative at $62 million, but it did improve by $9 million year over year. So progress, but still burning cash on that metric.
Okay, got it. Now, looking ahead, Q2 guidance. What are they telling us? Sounds like maybe some clouds forming.
Yeah, the guidance is softer. For North America, they're guiding to 1.225 million to 1.255 million subscribers. A 14% year-over-year decline using the midpoint. That's pretty significant.
Wow, okay. And revenue guidance for North America?
Also down $340 million to $350 million. That's about a 10% drop year over year at the midpoint.
Why the drop?
They're pointing to the impact of content they dropped, like the Warner Brothers Discovery and Univision networks, and also comparing against Q2 last year, which had some one-off big sports events boosting numbers.
Right. Those content decisions have a lingering effect then. What about the rest of world segment? Molotov, mainly.
Similar story, unfortunately. Q2 subscriber guidance is 325,000 to 335,000.
Which is down.
About 17% year over year, and revenue guidance is $6.5 million to $7.5 million, down around 15%.
Okay, so softer guidance across the board for Q2. Let's dig a bit deeper into what management actually said on the call. What were their main talking points?
Well, they really emphasized beating their own Q1 subscriber forecasts and hitting revenue targets in North America.
Despite the year-over-year drop in subs we mentioned.
Exactly. They framed that year-over-year decline as a result of beating their internal guidance, which is an interesting spin.
Okay. And they obviously highlighted the revenue increase despite fewer subs.
Absolutely. And that huge improvement in global profitability metrics, that's clearly priority number one for 2025.
Did they give any updates on the potential combination with Disney's Hulu Plus Live TV?
They mentioned it, yeah. So they're still working through the regulatory process, but no real new details beyond what was already out there.
Keeping cards close to the chest on that one. Understandable. How do they see themselves in this crazy fragmented streaming world?
They think the fragmentation actually helps them, strengthens the argument for their aggregation model, bundling things together.
The anti-fragmentation play.
Right. And they pointed out they were early movers on different package options, like skinnier bundles. They kind of suggested the industry is following their lead now.
Interesting. Are they planning more on that front? Skinny bundles?
Yes. A big goal is launching a skinny bundle focused on sports and broadcast channels for the fall sports season.
Including Disney content?
That's the plan, yes. And they're also actively trying to secure other non-Disney programming for it, but they stressed it needs to be on fair terms.
Okay, fair terms being the key phrase there, likely aimed at content providers. Now, you mentioned dropped content affecting guidance. How did it impact Q1 ad revenue specifically?
Ad revenue was down $22.5 million for Q1, which is a 17% decrease year over year.
Ouch.
Yeah, but they were very clear. The main driver was discontinuing Warner Brothers Discovery and the television Univision networks. Just less ad space to sell.
So fewer ad slots available.
Exactly. They argued that if you exclude that impact, the underlying ad performance actually improved.
Okay, so that context is important. And we talked about the litigation gain boosting net income and cash flow.
Right. A huge one-time item. But the adjusted EBITDA improvement, they'd say, shows real progress on cost control and efficiency.
And that Q2 guidance decline.
Mm-hmm.
It's still colored by those content drops and the tough comparison to last year's sports events.
Correct. They actually offered a different view, a same store basis, meaning if you hypothetically remove the impact of those drop networks and the one-off events from last year,
Then what?
they estimate North American subscriber growth would have been roughly flat year over year.
Okay, that does put the 14% projected decline in a slightly different light.
More context for the guidance. What about the economy? Seeing any slowdown from consumers?
Apparently not, or not significantly. They said they haven't seen major negative macro impacts on churn.
Really? Even with price increases? Yeah, they mentioned churn for the English package was stable or even slightly better despite raising prices.
That's surprising. And ad demand.
Also holding up, according to them, April was actually their best month so far this year for ad revenue growth.
Huh. Okay. Any other positive signs?
Customer reactivations in April were apparently better than they expected to.
Good to hear. And the ad revenue drag from losing Warner Brothers Discovery content.
They expect that to start normalizing now. Basically, post-April, the year-over-year comparisons get easier.
Got it. Let's quickly touch on the rest of world business again. Molotov. Declines there too, but what's the strategy?
Profitability over growth. That's the mantra. Similar to Fubo overall.
So optimize the team, the tech, find synergies.
Exactly. Build a sustainable base first. They did say international expansion is important long-term, and they're prepping for it, but the focus now is getting Molotov profitable.
And interestingly, the subscriber decline there actually helped their EBITDA.
Yeah, contributed to EBITDA coming in ahead of their budget.
Sure.
Again, shows that tight focus on the bottom line, maybe shedding less profitable subscribers.
It all comes back to profitability.
Yeah.
And just to confirm on ad revenue again, the Q1 dip was purely the lost inventory hours.
Directly linked, they said. Lost hours from Univision and Discovery. Normalizing for that, they believe Q1 would have shown growth year over year.
And they expect Q2 ad revenue to be better than Q1.
That's the expectation, yeah. Especially as they roll out new formats.
New ad formats, like what?
They mentioned interactive ads, like gamified ones. Those saw a 37% year-over-year increase.
Interesting.
And overall ad products are up 41% year-over-year for the first half. They said advertiser interest is picking up, especially for these newer formats.
Okay, lots happening there. Right, let's shift gears. Time for our This Is Not Financial Advice segment. Pure speculation, outrageous, but, plausible trade ideas based on the call. What jumps out?
Okay, first idea, playing on that skinny bundle strategy. Fubo needs content for it, specifically non-Disney stuff on fair terms.
Yeah.
So, an outrageous but plausible idea. Find a smaller, maybe even independent sports or broadcast content producer. Someone whose library or live rights might be really valuable to Fubo for that specific bundle.
And the play is?
A long position in that smaller content player. If Fubo does strike a deal, or even if speculation ramps up, that smaller company's value could jump.
The risk being?
The deal never happens, the terms are bad, or Fubo's skinny bundle just fizzles. High risk, potential high reward if Fubo pulls it off and needs that specific content.
Definitely outrageous, potentially plausible. Okay, what's idea number 2?
This one leans into the improved profitability metrics and the ever-present possibility of that Hulu plus live TV combination, even though there's no news.
Still hanging out there.
Exactly.
Right.
So maybe a speculative long position in Fubo itself, but hedge it.
Hedge it how?
Maybe with a short position in a traditional cable provider, one that's clearly feeling the cord-cutting heat that benefits players like Fubo.
So betting on Fubo's operational improvements and the potential merger upside while betting against legacy cable.
Kind of. The merger is a total long shot. Regulatory hurdles are real. But if it did happen, combined with their profitability focus, FUBO stock could get significantly re-rated. It's a wild card play, definitely.
Wild card indeed. Two very different speculative angles there. Okay, good stuff.
Just ideas to mull over.
Absolutely. So that wraps up our deep dive into FUBO's Q1 2025 earnings call. We've pulled out the key numbers, the strategic shifts, the guidance, hopefully giving you the essentials.
Yeah, the core insights without the hours of listening.
And remember, everyone, what we talked about here, especially those trade ideas, it's purely for informational purposes. It is absolutely not financial advice.
Please do your own homework. Dig into the details yourself, consider your own situation and risk tolerance before making any investment decisions.
Couldn't agree more. So what do you think about Fubo's push for skinny bundles? Or the chances of that Hulu deal ever happening? We'd genuinely love to hear your perspective.
Yeah, join the conversation. Let us know your thoughts.
And make sure you tune in next time for another essential earnings call breakdown, right here on Talk Tickers.